Listen up everyone, this is incredibly important, especially if you're retired or nearing retirement. This could save you thousands of pounds, potentially tens of thousands over the course of your retirement. We're talking about real money that can make a significant difference in your quality of life. There's a new IRS rule coming into effect in 2025 and it's crucial you understand how it works. This new rule fundamentally changes how your retirement income is taxed at the federal level, especially for seniors who rely on Social Security and other forms of retirement income. It's designed to adjust the tax burden based on income levels, but the implications can be complex. Too many people are completely unaware of this change, missing vital information, and it could cost you dearly in the form of higher taxes and reduced retirement savings. Ignoring this could lead to a significant financial hit. The rule specifically affects how much of your Social Security benefits are subject to federal income tax. It also impacts the taxation of your state pension, as well as other forms of retirement income you might be receiving. The amount of tax you pay is based on your provisional income, which is a calculation that includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. For years, the income thresholds used to determine how much of your Social Security is taxed haven't been adjusted for inflation, but your cost of living has increased dramatically. Everything from groceries to healthcare is more expensive. As a result, more of your retirement income is now being taxed than ever before, pushing many seniors into higher tax brackets. This increased taxation is quietly eroding your savings and reducing the amount of money you have available for essential expenses. If you're living on a fixed income, as many retirees are, an unexpected tax bill can completely disrupt your carefully laid plans and throw your budget into disarray. This can cause real stress and anxiety, impacting your overall well-being and peace of mind. Financial worries are a major source of stress for seniors, but this isn't about instilling fear or panic. It's about being prepared, proactive, and taking control of your financial future. Knowledge is power, and understanding these changes is the first step. The government isn't going to proactively tell you how to pay less tax. They're not in the business of reducing their own revenue. Understanding the rules and finding legal ways to minimize your tax burden is your job and your responsibility. Today I'm going to give you clear, actionable, and practical steps to protect your hard-earned money and ensure you're not paying more tax than you absolutely have to. You absolutely need to know the new rules and understand how they impact your specific financial situation. This knowledge is essential to keep your retirement secure and maintain your desired lifestyle. Don't rely on old assumptions or outdated tax advice. What worked 5 years ago or even last year simply won't work now with these new regulations in place. Every pound counts, especially when you're living on a fixed income, and you absolutely cannot afford to lose money to avoidable taxes that you could have legally minimized. I'm going to walk you through exactly what's changed with this new IRS rule, and more importantly, what concrete steps you can take right now to mitigate its impact on your finances. So stay with me, pay close attention, and let's make absolutely sure that your money stays where it rightfully belongs, in your pocket. So, without further ado, let's get started and dive into the details of this crucial new IRS rule. Who's truly at risk of falling into this financial predicament? It's a question many are asking, especially as retirement planning becomes increasingly complex. If you have more than just a state pension, like IRAs or other private pension schemes, 401(k)s, especially if you've diligently contributed over the years pensions or investment income, perhaps from stocks, bonds, or property, pay close attention. This isn't something to gloss over. It requires careful consideration. The loss could be £4,500 or more, a significant sum, enough to cover major expenses like unexpected medical bills, home repairs, or even a well-deserved holiday. The danger comes when your combined income crosses certain thresholds, often unexpectedly, making more of your pension taxable, potentially pushing you into a higher tax bracket. Many don't realize IRA withdrawals count toward this calculation, adding to your overall taxable income, triggering a domino effect where one income source impacts the taxability of another. For example, a couple drawing from both state pension and an IRA, supplementing their income, can suddenly see 85% of their benefits taxed, a significant jump, not just 50% or zero, as they might have initially expected based on previous years. This is the £4,500 trap. A potential pitfall, not understanding how your income streams interact under the new rules, leading to unexpected tax liabilities. If you have multiple income sources from various pensions to different investment accounts, you're in the risk category. It's crucial to understand how these sources are taxed, but don't panic. Being at risk just means you need to act proactively and seek clarity. Recognizing this is the first step to protecting your assets and ensuring a comfortable retirement. Now let's break down how the rule actually works, demystifying the complexities and empowering you with knowledge. Knowledge is your best defense against this potential financial pitfall, allowing you to make informed decisions. The key issue is how provisional income is calculated. Provisional income equal, sign your AGI, tax-exempt interest, 50% of your Social Security or state pension. The problem? The income thresholds for taxing your benefits haven't changed in decades. For 2025, if your provisional income is above £34,000, single, or £44,000, married, up to 85% of your benefits are taxable. These thresholds are outdated. More people are getting taxed every year. It's not a new law, but the effect of inflation and rising incomes against old rules. Normal withdrawals or investment gains can push you over the line. The takeaway: you can't control the thresholds, but you can control your income sources and timing. Structure your withdrawals to keep your provisional income below those limits. That's how you keep more money in your pocket. First, list every source of income for 2025. State pension, private pensions, wages, interest, dividends, IRA, or 401k withdrawals. Add them up to estimate your AGI. Then add 50% of your annual state pension to that number. This is your provisional income. If it's over the threshold, more of your benefits will be taxed. Seeing the numbers on paper is a wake-up call. Identify which income sources are fixed and which are flexible. Often IRA withdrawals are the lever you can adjust. This review turns a vague risk into a specific, manageable issue. Don't skip this step. It's the foundation for every other strategy. Know your numbers and you'll know your risk. Now let's talk about how to use your accounts to your advantage. Clarity is your first line of defense. When it comes to planning for retirement, it's crucial to understand that not all retirement accounts are created equal, especially when considering the impact of taxes. The type of account you choose can significantly affect your tax liability both now and in the future. Traditional IRAs and 401ks are tax-deferred accounts. This means you don't pay taxes on the money when you contribute, but you will pay taxes when you withdraw the money in retirement. This can be a good strategy for some, but it's important to remember that those withdrawals count as income and can push you over the threshold for higher tax brackets or even impact your Social Security benefits. Careful planning is essential to avoid these pitfalls. Roth IRAs, on the other hand, offer a different approach. These accounts are tax-free in retirement. You pay taxes on the money when you contribute, but qualified withdrawals in retirement are completely tax-free. This means those withdrawals don't count toward provisional income, which is a key factor in determining how much of your Social Security benefits will be taxed. If you have a Roth IRA, use it strategically to stay under the limit for taxable income and minimize the impact on your Social Security benefits. No Roth? Consider a Roth conversion as a way to diversify your tax strategy. A Roth conversion involves moving money from a traditional IRA or other tax-deferred account to a Roth IRA. You'll pay income tax on the amount you convert now, but all future growth and withdrawals will be tax-free. It's essentially paying tax now and enjoying tax-free withdrawals later. Convert in low-income years when your tax rate is lower. This will help to minimize the tax hit from the conversion. Don't convert too much at once, as this could push you into a higher tax bracket. Instead, spread it out to avoid higher tax brackets and potentially negating the benefits of the conversion. Each conversion gives you more future flexibility and less taxable income in retirement, allowing for better control over your finances. The ultimate goal is to build up your tax-free bucket, your Roth accounts, to a substantial size. This will give you greater control over your taxable income in retirement and help you manage your tax liability more effectively. By strategically using the right account at the right time, you can protect your benefits and minimize your overall tax burden. Smart account management, including Roth conversions and strategic withdrawals, is your tax shield in retirement, providing financial security and peace of mind. Timing is everything. Instead of automatic monthly IRA withdrawals, plan your income annually. Need a large sum? Split withdrawals across 2 tax years to avoid crossing thresholds. Time investment sales or Roth conversions for years when your income is lower. Map out your expected income and expenses at the start of each year. If you're close to a threshold, adjust withdrawals or use Roth funds. Use cash savings when possible to avoid extra taxable income. Proactive timing keeps you in control and out of the tax trap. Don't let the tax code dictate your outcome. Plan ahead. Be the architect of your financial year. If you're over 70 and a half and give to charity, use qualified charitable distributions, QCDs. Donate directly from your IRA to a charity. This money doesn't count as income and lowers your provisional income. QCDs count toward your required minimum distribution, RMD. For example, if your RMD is £15,000 and you donate £5,000 via QCD, only £10,000 is taxable. The donation must go directly from your IRA to the charity. You can give up to £100,000 per year this way. QCDs are a powerful way to lower your tax bill and support causes you care about. If you're taking RMDs and give to charity, this is a must-use strategy. It's a win for your taxes and your community. Don't miss out on this benefit. Let's recap your action plan. First, audit all your income sources for 2025. Know your numbers. Second, understand your account's tax-deferred versus tax-free. Use Roth withdrawals or conversions to manage your taxable income. Third, master timing plan withdrawals and big expenses to avoid income spikes. Spread large withdrawals across years if possible. Fourth, if you're over 70 and a half and give to charity, use QCDs to lower your taxable income. These 4 steps put you in control. Don't just listen, take action. The sooner you start, the more you save. Your financial future depends on it. The 2025 tax changes are a challenge, but you're ready for it. Losing £4,500 isn't inevitable. It's a warning to act. You've worked hard for your retirement. Don't let taxes erode it. Awareness and strategy are your best tools. Use the right accounts, time your withdrawals, and leverage Roth conversions and QCDs. Start planning now. Don't wait for a surprise tax bill. If you need help, seek professional advice, but take the first step yourself. You are the CEO of your financial life. The IRS doesn't decide your destiny. You do. Be proactive, stay informed, and keep your money working for you. You have the knowledge and the plan. Now secure the future you deserve. You can do this.